Hello, ladies and gentlemen, and welcome to our interview with Jarid Beck. Jarid is the director and co-founder of Risk Management Advisors, Inc., a firm specializing in creating and managing captive insurance firms for businesses in different range of industries. And Risk Management Advisors currently manage the second largest number of captive insurance firms in the world. So, Jared, thank you very much for joining us today for our Risk Management Show interview.
Of course, thanks for having me.
Absolutely. So, we interviewed last year Wesley Sirk from your company, and was quite interesting interview with specifically captive insurance accent. And today we will continue our thoughtful conversation. I believe we will take more steps to understand how companies should take what companies should take to cover their risk with your perspective. So, and specifically because you cover a captive insurance industry, so I believe we will concentrate on the risk covering by your company. So, could you tell us first of all a short story about your career path? What brought you to where you are right now, and what you guys at Risk Management Advisors are up to these days?
Yeah, thanks. And I'm glad you had time to visit with Wes. He's fantastic, and I'll try to try to live up to the high bar. But yeah, so Wes and I co-founded Risk Management Advisors back in 2004. And prior to doing that, we had been in the financial planning space, working with business owners on a variety of things, insurance strategies, risk management strategies, tax reduction strategies, retirement plans, benefits, et cetera, really, kind of holistic consulting, if you will. And we discovered captive insurance companies as this really neat, multifaceted, tool that had so many different applications. And it was at that time that we decided, let's make this the focus of our practice, and really get the word out to different types of businesses about this this awesome tool. Fast forward 2019, we merged with a company called Risk Strategies, which is a fairly large benefits and property casualty broker, and they asked us to head up their captive insurance practice. And so we've been doing that for the last 3 or 4 years now. And as you said, depending on whose list you look at, we're one of the larger captive managers out there. And demand is really at an all-time high. There's a big need for it. So I think your topic of, what risks do we want to identify for this structure is really timely.
Mm-hmm. All right. So because our audience is mostly risk and compliance managers, can you discuss some of the common risk management strategies that companies employ in their life cycle?
Yeah, so from a risk management perspective, captive insurance companies, it falls along that continuum of, aside from just buying, shelf products, transferring risk vis-a-vis insurance, are there other ways to more efficiently finance risk? And, in some cases that can be, self-insure, set up self-insurance reserves, or in some cases, take that next formal step of going out and, setting up your own insurance company and getting your own captive, licensed with the Department of Insurance to address those specific risks. So, again, it's really when you've identified certain lines of coverage or certain risk factors that, either one, we can't find adequate coverage for, the insurance market hasn't caught up with this risk that we're facing, or the insurance market doesn't have an appetite for it. And then so, do we look at captives or, some sort of risk financing strategy to address that? Or perhaps it's a line of coverage where, you're spending a disproportionate amount of the budget. It's a big line item. And the value trade-off isn't really there. Either, it's so exorbitantly overpriced for what you're getting. We can talk about some of those examples that we're seeing today. Or, maybe it is fairly priced based on what it, should be for the overall market, but your losses and the way you're controlling risk, have it such that, you're subsidizing everybody else's bad loss experience because you're doing things so well. So those are really the conundrums that we find risk managers, finance, insurance stakeholders in, and that's usually when they're calling us to, say, hey, what are some of the alternatives out there, that we just kind of clipped through right there.
Mhm. Is this mostly applicable for United States market or overall? Because I'm based in Europe, I don't hear much about captive insurance strategy.
Yeah, it's interesting. The motivations are different, but captives are actually a fairly robust tool globally. So I'd say 90%, 95% of our clients, most of their activity is domestic. We're in the United States. That being said, there's huge captive markets in European countries, Asian countries, and a lot of foreign companies or international companies utilizing captives for a variety of things. And in fact, I mean, in some cases, the European markets are more advanced than the U.S. markets on certain strategies, pension relief, healthcare, cost of healthcare relief. Some of those risks, we see more sophisticated strategies overseas than we do in the States. But so it can really, it all comes back to, what's the insurance problem that you're trying to solve, the risk management problem. And I think that's pretty universal, regardless of where your company is sited.
Mm-hmm. So if there is how can companies balance the costs of risk management measures with the potential benefits on specific, maybe if you have specific examples in specific industry, what are kind of in it? I know we spoke with Wesley about more healthcare kind of. Maybe there are some other benefits as well.
Yeah, and healthcare continues to be an issue. So I'd encourage your listeners to go back and if they have clients that have difficulty with the the healthcare space, I'd encourage them to go back and revisit that episode. But some specific examples, what we're seeing in the property and casualty market these days, first off is the property, property insurance, for companies, that have large portfolios of real estate. We're seeing a really difficult time in terms of, there was many years where the insurance companies were underpricing their product. And then natural disasters, a combination of other factors, interest rates. Now it's, they didn't collect enough premium to cover the losses. So now they're coming back and trying to do it pretty aggressively. We're seeing premiums doubling, with restrictions in coverage. So for our clients that have set up captives or, some sort of alternative structure, let's say 5 to 10 years previous, they've been in a much better position to, adjust to those, to those changes. Their captives are able to absorb, some of the limits that the carrier won't put out. We're even seeing captives now participate in excess layers, or higher levels of coverage up the property tower, or across the blanket policy portfolio. We used to never see that. And again, that's folks that had set stuff up a while ago, had the foresight to do that. What we're dealing with now is a number of calls from folks maybe who didn't do that, but are looking to establish a captive to address some of the coverage limitations, and frankly, just look for spots to take on more risk to get some relief from the carrier, and then hopefully losses don't occur. You avoid the natural disaster, and then you're able to recoup that underwriting profit in the insurance company. So that's on the property side. Another area we're seeing a lot, a strange amount of difficulty is in the D&O, directors and officers marketplace. And this can apply to all industries, but it's specific. What I'm thinking of is, in the cannabis industry, the cryptocurrency industry, and really any emerging market where you have companies that were sort of nascent by nature, growing, and then now they're becoming more sophisticated. They've got boards, and so they need to provide this directors and officers coverage. But again, the insurance markets are uncertain or unclear on really how the industry works and are being cautious in their underwriting. And we're seeing some pretty outrageous pricing. So we're seeing, directors and officers coverage, 600,000 and 700,000 for 2 million of coverage. Right. Wow. So, I mean, on an annual basis, that's pretty, it's pretty hefty. What you're essentially saying there is we assume there's going to be a full limit loss every, 3 to 3.2 years, which is, as wild as these industries may be, or perception being, that's probably not realistic, right? So we're sitting with risk managers or finance folks and saying, hey, look, you're sending $600,000-700,000 out the door. You have capital. Is it worth it? Is the return on investment there to simply set up your own insurance company, pay in the 600,000 or 700,000, capitalize or collateralize the rest of the limit, and for a fee you can get an A-rated carrier to issue you a policy, that sort of put some high credit behind that funding. And are you better off doing it that way? And we're having a number of those discussions, again, across those kind of emerging industries. And then I would say the other big issue you're facing, and this is global in nature, is cyber coverage. Cyber liability. You had early on, you had cyber policies that exactly were sold inexpensively, but they didn't cover a whole lot. And then so when people had losses, items were excluded. There was a lot of turmoil around that. And then the insurance companies got smart. They hired, tech people to come in and do their underwriting. And so they got, a lot of things covered, but the premiums were, somewhat inadequate. And then so you had too much paid out in losses. And then now, of course, we're going in the other direction where we're charging high premiums, getting really restrictive with the coverage right at the time where, companies are often required by their contract partners, to actually have the cyber coverage, evidence high limits. So they're in this spot where, they've got to buy this really pricey limited coverage, to satisfy their certificate holders. And so that's been a big issue of either kind of like the D&O, do we just outright insure the whole cyber policy in a captive, or do we utilize a captive to cover some of those gaps, deductibles, exclusions, et cetera, and make sure we have the comprehensive coverage that actually means something at the end of the day. So those are the three things that spring to mind.
All right. So you explained all this potential benefits and use cases. So how advances in technology in data analytics impacted the way companies approach risk management, especially in your area? And maybe can you discuss the process of setting up and managing a captive insurance company?
Yeah, the data analytics part is becoming a bigger and bigger piece. I mean, it allows you to make, so much of it was, in the past, the conversations you'd have, it was, a lot of gut-based stuff. You had your carrier loss runs, and then it's, well, we're doing things pretty well. But it was anecdotal, right? It was just, kind of recency bias or whatever they had seen. But, really being able to dig down, and understand, all right, if we do this, what's the probable outcome? And then really helping, both just even us as consultants, or certainly our actuary partners, make better recommendations about, hey, if you take this risk, here's the probability of this not working out for you. The access to data, the volume of data has certainly been huge, especially when, I'll give you an example. We're working on a captive program for a large actually large multinational, insurance firm. And they've grown so much. They've grown so much. So even though they've got 7 years of loss data, it's not, 5 years ago isn't particularly useful because they were 1/6, the size. But having access to, multitude of databases of industry loss data has been really helpful in constructing the potential captive model that we're looking at there. You mentioned healthcare before. I would say that's the biggest piece, is kind of unlocking that black box and getting actuaries and consultants access to real-time data on billing, price transparency, frequency, severity of conditions, which is super key as medical technologies emerge, to treat conditions. There's going to be more and more focus on, all right, well, how do we fund, if you got gene therapies, right, on the health insurance front, the high cost, specialty drugs, what's the frequency, what's the severity, what's the use cases. Having access to that data is really going to, help us work with companies on how do we finance this stuff? What's the most efficient way? So that's huge. And hopefully that makes sense. With respect to how do we get started, or how do we determine if this makes sense? Usually starts with hey, I've got a problem discussion, right? We get the call either from an advisor, a lot of we're seeing a lot of sophistication in the brokerage market now. It used to be the P&C brokers, want to put their head in the sand when it came to alternative risk financing strategies or captives generally. But we're seeing a lot of discussion initiated on that side now. So I think, one, out of self-preservation, they don't want somebody else to come in and do it. And then I think they want to add value for their clients. So we're seeing a lot of brokers coming in and starting the discussion about, hey, does a captive make sense for this company? Or we get a lot of calls directly from, the folks in charge of risk or the other stakeholders within the company. And it's just starts with a discussion about, what are the problems we're trying to solve? When you think of a captive, what is that? That can mean different things to different people. And so what does it mean to you? What are we trying to achieve? And if we mutually determine that there's something there, then, there'll be an exchange of information, some preliminary data changing hands, so we can do what we call a preliminary feasibility study, where it's, before we enter into an engagement or any money changes hands, we simply, look at the data and, say, hey, is there traction here for solving some of the problems that, that you're looking to solve, and, do a preliminary analysis around that, and then come back, have a broader discussion. And then it's at that time, if the end user, says, yeah, this sounds really great, this sounds like something we can help, then there would be a formal engagement, for us to implement the program, set up the insurance company for them. And depending on, sort of tailwinds we get, how fast everybody moves, the actual formation of a captive now is really, it could be a 5 to 6 week process once the decision to move forward has been made. Some of these domiciles are really responsive and have really good teams, supporting the advisors that are bringing the captive formations to their jurisdiction. So,
all right. So I believe we've got a good overview of potential benefits and how to set up a company. So now I would like to ask you a personal point of view. So what is a commonly held belief or biggest misconception in the field of captive insurance that you kind of strongly disagree with?
The biggest misconceptions?
Yeah.
I think there's a couple. I complimented our P&C broker partners, just a second ago, and rightfully so. However, we do still see, sometimes people say captive insurance, I want to do captives, or I want to do self-funding. And what they really mean, or what their client perhaps really means, is I want cheaper insurance. So we still see, the renewals on January 1st, And we're getting the call on December 10th saying, you know, hey, we're having a tough renewal. We want to look at captive. And, you know, as you know, you know, captives are not, you know, it's not something you do overnight.
Yeah.
And, you know, it's not necessarily something that's going to result in, you know, it can, but it's not necessarily something that's going to result year one in just a cheaper outlay for insurance. It's not a commodity in that way. And so we still see a lot of that. The best time for the captive discussion is really, you know, months in advance of the renewal for whatever, you know, for whatever problem you're trying to solve. So you have the opportunity to do what we're doing now, Boris, is talk through, you know, the educational pieces. What is this? What can be done outside the pressure of having to make a financial decision? So I think that misconception that, you know, that misconception that it's a, you know, a commodity that we can just, you know, issue a quote, if you will, for, I think that's still out there a little bit. And then I think on the flip side of that, I think, you know, we asked a lot of our clients, we did a survey and we're like, hey, thank you for choosing risk management advisors. You know, why did you choose risk management advisors? And then like, why did you almost not? Or why did you almost not set up a captive? And the surprising, overwhelming majority was everybody, the perception that it was going to be so much work, you know, that it was so complicated. And so we felt good that, you know, we'd made the process, you know, simple and accessible, you know, for the folks we were working with. And I think if you do it the right way and work with the right partners, you know, it doesn't have to be, you know, overly complicated. And then again, if your captive manager, your consultants are doing it right, you know, they're helping you get the benefits of the captive without, you know, distracting from what you do on a day-to-day basis. Basically, you can be as highly involved as you want or as remote to the process as needed. But I think that perception that it's, you know, that it's just, oh, so many moving parts and so difficult. And, you know, again, there's a lot of talented people out there, not just at RMA. There's other really good advisors out there that are, you know, able to simplify the process. And I think that's important for people to know.
Fantastic. So if we summarize our interview for someone who is listening to it, and for example, what is the major takeaways people, or maybe one or two major takeaways people will need to take from this interview?
Yeah, I think the big takeaways are, you know, the insurance market is difficult, and you know, some of the areas we talked about, I think that's going to be the way for the foreseeable future. And so, you know, if you're in one of those spots, you know, captives can be a potential solution for you. Here's the other thing: if you happen to be in a spot where the insurance market is easy right now, you know, and we were talking to she was the risk manager and newly appointed CFO, dual roles, heavy crowns. You know, and she was saying, well, you know, hey, my renewals have been flat for the last 2 years, but given this particular line of coverage, is very uncommon for, you know, for that industry, for that line of coverage, for them to have flat renewals. So they're obviously doing something right. But, you know, what I suggested was, you know, hey, that's good. Are you going to be prepared when that changes? Because again, looking at the data, to your point, Boris, this is not something that is going to, you know, be sustainable for, you know, next year, the year after. There's going to be some inflation in your cost. And, you know, are you going to be ready for that, or is it going to be a reactive thing? So anyways, long story short, point is, if you've got, you know, if it's not an issue right this second, you know, my partner, Wes, you mentioned earlier, he's got a great saying. He says, build your ark while the seas are calm. You know, don't wait for the storm to reinforce your boat, to build your ship. You know, you build it now. So, so even if you're not in that spot, but you're of a certain size where, you know, hey, if things take a turn for the worst, you know, that would stink, then, you know, maybe looking at a captive there. And then again, just keeping in mind, you know, if you're working with the right folks, it doesn't have to be too tough, too complex. And, you know, I think those are key takeaways.
All right, fantastic. I think we got great understanding now what captive insurance is and how people can use it in the industry. So if there that's were all my questions. If I forgot something and you would like to add anything that's important to you, please go ahead.
I really think we covered a lot in a short amount of time from a conceptual standpoint. Folks have more interest or more questions. Again, I would encourage them to revisit, your great library of content. And then we have a lot of good information on our website at riskmgmtadvisors.com. And then, also our YouTube channel, Risk Management Advisors.
Okay. All right. Thank you, Jared, very much. And perhaps in a few months we can come together and discuss with you guys another topic of importance.
I would love that. Thank you, Boris.
Thank you. Bye-bye.